Hello everybody and welcome to the Like Tortoise channel. Here we are for another video, and today is going to be about your suggestions, okay? So one of our dear subscribers who's been with the channel for a while now, White Woody, has asked me to analyze two companies, eToro and Mint, and these are the companies that I will delve deeper into today. In addition, some of you asked me to analyze SAP, and I will do that as well. And we will discuss whether or not I think these are quality businesses and if they are trading at the big margin of safety. Okay, we don't know, but what we do know is that some of these names are well off their all-time highs. So maybe this will present an opportunity for us, long-term tortoise type of investors. Thank you so much again for watching the videos and putting up with my boring voice. And before I discuss today's video, I just want to I feel compelled to discuss something right here with all of you because I know many of you started following the channel exactly because I invested in PayPal and created quite a few videos on the company. And sure enough, today the new CEO Enrique Lores steps into the big shoes. Okay. And he put out an interesting LinkedIn post saying, as a member of PayPal's board of directors for the last 5 years, I've had a front row seat to PayPal's strengths, our global scale trusted brand, powerful two-sided platform of consumers and merchants, and most importantly, our people. We have significant strengths, but we have not executed to our full potential. Now is the time to turn those strengths into sharper focus and stronger, more consistent results. We operate in a highly competitive, fast-moving environment. Winning requires clear priorities, discipline, execution, and innovation that consistently improves customer experiences at scale. PayPal has a vital role to play. Over the coming weeks, I look forward to spending time with customers, partners, and teams globally. Listening and learning will be essential as we move forward. And of course, I feel as a shareholder, right, in the company, yes, I haven't sold a single share, as you all know. I felt compelled to leave a comment right here, a challenging comment, but however, very transparent and honest. Congratulations on stepping into the big role, Mr. Enrique Lores. For sure, this won't be an easy job, but I know you understand this better than anyone. Branded checkout, yeah, is where PayPal is bleeding and where more focus will be needed. In addition, as a shareholder, I would love for you to continue with buybacks and be adamant about not selling the company in the dump. Okay? Not selling the company in the hole. That's what I mean, right? Because we are long-term shareholders. We know the company is worth a lot more than the price that it's trading at today. And for sure, we don't even want them to consider selling the company at these ridiculously low prices. Okay? So, Enrique Lores, all the best for you, my friend. Okay, let's go back to our video today and let's discuss these companies and whether I think they are high-quality companies. Okay, so right here we have our stock and lock, as you know, which is the platform that I choose. Well, it's actually the only stock analysis platform that I have a subscription with, right? And so I also use stock analysis, but that is completely free. But I want to see several years of financial data, and that's why I decided to pay a subscription right here. Okay, so let's start with our income statement, and as you can see, revenues have been compounding by about 5-6% per year over the last several years since 2015. Ideally, I like to see this at or above 10%, so it's not ideal. However, I mean, it's consistent, right, and steady growth, which is very important too. And you can still make a lot of money as a shareholder, even with sluggish growth in revenues. Take that into account. Earnings, look at that. So earnings are a bit bumpy, as you can see, but they have grown by about 9% since 2015. They are quite bumpy, however, so this means we will probably choose free cash flow. It's a software company, so I'm assuming free cash flows are greater than net income, right? But you have to understand why there is some bumpiness here, maybe due to some acquisitions. I don't know. I don't understand the company. I'm only sharing my thoughts of the company purely from a financial standpoint. All right, there's so much more that goes into understanding the business. It's ridiculous, and you guys got a feel for that when I put out my video on Constellation software, because I really went in all in on the key metrics, right, and the key questions that I ask every time I decide to invest in a business. Okay, so let's move on. I can see that diluted shares outstanding have been slightly declining. So since 2015, they declined by about 2.43%, which is, I mean, not amazing, right? But at least we are not seeing any dilution. Okay. What about operating income? This has been going up by about 6.32% as well. And most importantly, look at that. Look at that. It's currently at all-time highs. All right. So I like that. Revenues are at all-time highs as well. And you can see that diluted earnings per share are also at all-time highs. So this is important. Okay. Let's have a look at the margins. Sure enough, gross margin is quite stable. You can see that operating margin is actually going up since the recent lows in 2021. So we are seeing some operating leverage, which is pretty good, right? And you can see that net margin is also going up, while not at all-time highs. You can see how you can see the strength in this uptrend, okay, which is very good. And look at that. The average is about 15%, and we are at almost 20%. Let's have a look at the balance sheet right now, and we can see that assets have been growing by about 5% as well since 2015, which is good. In addition, you can see that total cash currently sits at about 10 billion, and they have current liabilities at 25. Okay, so assets seem to be growing faster than liabilities. As a result, you can see that book value has been compounding by about 6.75% since 2015. Okay, but you can also see that the company sits on a net cash position. In other words, if you do total cash and cash equivalents minus total debt, right, you will get a net cash position. And you can see that right here on stock analysis. Look at this. If I go right here to SAP, they have a $2 billion, that is the net cash position. When you subtract total cash and cash equivalents, subtract total debt by cash and cash equivalents, this is what you get. In addition, which is very good, look at the financial position. So the debt to free cash flow sits under 1, which means they can cover all of their debt within 1 year of current free cash flows. Very good. And they can cover all the interest payments on the debt as well with no problem, right? So look at that. How do you calculate interest coverage? You do the EBIT, which is the operating income, divided by you do the operating income divided by the interest expense. So they generate enough operating income to cover all the interest expenses, and that is exactly what we want in a company. So what else do we have right here in terms of margins? So we already discussed that margins are quite healthy, and you can also see that free cash flow margin is above the profit margin, right? Which means they produce higher free cash, exactly as I expected, because they are a software business. So if you go to free cash flows, they are greater than net income, as you can see right here. Look at the free cash flows. Right here, free cash flow sits at about 8 billion and a half, while net income sits at about 7 billion. Okay, so and you will use free cash flow to determine the intrinsic value of the company, as it's less bumpy. Okay, now another point that I would like to discuss right here is the returns on capital, which is important. We care about that as long-term shareholders. And what you can see is that ROS is currently almost at all-time highs, right? ROIC has been going up as well, almost at all-time highs. Return on assets is almost at all-time highs, going up. So what I see is a company that is actually improving its fundamentals. And what I also notice is that analysts, if you go to FinChat, they are projecting 17% long-term growth for the earnings per share, which is staggering, right? We already discussed that over the last 10 years or so, the company has only grown diluted earnings per share by what? About 8%, give or take, right? And so let me have a look at that right here. If you come here to the income statement, you can see that over the last, now let's go, the diluted earnings per share about 9%. And now they are projecting 17.7% growth in earnings per share going forward, which is staggering. Now, another thing that you have to assess is the company's stock-based compensation. And I can see that stock-based compensation is well within our 10% range, so it's not worrisome. And most importantly, I can see that this has been going down, so they are probably doing more cash incentives, which I like. I like to see that. And on a trailing 12-month basis, you can see how sharp the decline actually is. So that's it. This is right off the bat. I like what I see, right? So I see the company that is improving its fundamentals while the stock is declining, so the share price. Let's have a look at what the insiders are doing, but you can also see that the insider ownership is quite high. So we are talking about an owner operator right here, ladies and gentlemen. If I go to ownership, the ownership tab right here, show only company executives, I have nothing. So nothing is showing up, which is quite frustrating. But let's have a look at the insider transactions and see what the guys are doing. All right, what else do you need? Look at this. You can see that there's a lot of buying pressure, as a matter of fact, from insiders, which is very, very good. This is exactly what you want to see. The CFO is buying the stock. The COO is buying stock. Some board members are buying stock. This is exactly what you want to see. A lot of buying pressure going back all the way to June 2025. And more recently, they were buying a lot of shares in January 2026. So I like this company. I mean, I really do. Understand what the moat is, understand why this company cannot be disintermediated by AI. But from a financial standpoint, I mean, I really like everything that I'm looking at. And in addition, you have a free cash flow yield of about 4.32%, which is above so it's above the risk-free rate, right, which is usually the short-term treasury bonds, and they currently yield about 4%. But then here you also have the advantage of price appreciation on top of the dividend yield that you are getting. And what is the dividend yield? Yes, because this company pays dividends, the dividend yield is quite low, but the payout ratio is 40.50%, so this is good. And in addition, the dividend has compounded nicely over the last 3, 5, and 10 years, which is very good as well. So they have plenty of room to continue to expand that dividend over time. And because the payout ratio is only at 40%, right? So, and the payout ratio, for those of you guys who are new, you just do the dividends divided by net income, right? Dividends come out of earnings, and so I like to see that under 60%, and this is positive. I like to see that, okay? And that's why they have a dividend insight score of 3.75 out of 5. Okay, now let's talk about valuation. That is the next step. And from a relative standpoint, let's have a look and see what we have right here. Let's go to our metrics and let's analyze this company from a price to free cash flow ratio. And you can see that going back several years, right? You can see since 2015, the lowest price to free cash flow the company has ever traded at is about 19.27. Right now we have 28.89. Okay, the high is about 62. We are well off those highs, but we are certainly well above the recent lows. But this only tells you so much about the valuation. Okay, from a price to operating cash flow is more of the same story. So we are well off the highs. It's coming down, but it's still well above the recent lows. Excuse me, yeah, the lows of 2016. So now let's put a value on the company. And by the way, everybody, according to SAP, according to Morningstar, this company has a wide moat, okay? And the fair value estimate is around 265 euros per share, and the stock is currently trading at 163, which gives you a big margin of safety. However, is the company cheap using the tortoise using a tortoise framework? Let's find out. And if I go here to our intrinsic, so first of all, we already determined that we will be using free cash flows, right? So the free cash flows, let's go here to the cash flow statement. And the free cash flow, let's use 80 billion instead of 8,470 million. So let's just use 8 billion. Okay. So we will use 8. Is this trailing 12 months? Yes, it is. In fact, let me just go here. I hate having to juggle different to toggle between these different platforms, but they I don't see everything that I want in a single one. But okay, so the cash flows right here. Let's use they do some share based compensation, but it's not that significant. However, I will use 8 billion. Okay, so we have 8 billion in free cash flow. And what is the diluted shares outstanding? That is about 1175. Let's take that. Yeah, let's do our analysis right here. Okay, this is our DCF model, as you guys can see. So that this is about 8 billion, and shares outstanding, we have about this many, right? And you have the stock price of about 168, I think, something like that. Okay, now analysts are projecting earnings per share growth of around 70.7% going forward. I'm going to grow, I'm going to use 15% to be conservative as well. And notice that my desired return is always 15% because, the reviewers, I want to double money every 4 to 5 years, so I use 15%. And if you do that, you get an intrinsic value per share of about 126, with the company currently trading at 160 something. I don't yet have a margin of safety, my margin of safety. And for that reason, I will take a pass. That said, I like this company. I think it's a quality business that is already trading it's trading. So we've done the DCF. Now let's reverse things and let's determine the growth that is currently implied in the current stock price, right? And so, because with the stock currently trading at with the stock currently trading, it doesn't give me like this, so I have to go here. With the stock currently trading at 163, right? So we're going to have to do things. We're going to have to move the growth rate up until we get the intrinsic value per share of 163. And if I do 18 right here, you get 154. And if you do 19%, you get 164. So what this tells you, everybody, is that the market is assuming that SAP is going to be able to compound free cash flows at about 19% per year over the next 10 years. And as shareholders, as investors, right, as we have to ask ourselves, do I think this makes sense? Can this company grow free cash flows at 19% per year over the next 10 years, right? And that if that happens, then you will have a 50% return on your investment. I don't think so. I don't think these growth assumptions are conservative, especially when you consider the growth of the free cash flows going over the last 10 years, right? Which happened to be under 10%. And so I'm taking a pass because it doesn't meet my valuation, it doesn't meet my margin of safety criteria. That said, as I mentioned, it's a quality company. Now, let's move on to the second company, and that is eToro. And what you can see, so let's go right here right? I want to see the charts. And you can see that eToro is a company that only IPO'd just a few. When did they IPO? So they IPO'd in May 19th, 2025. Okay. So this company, if I show you this right here, let's go back here. I mean, this is not a company that I would buy. Okay. Don't, I don't like that. Yes, they are down substantially. So eToro engages in the development, even though I use them. Okay, it's once again for educational purposes, but I would never invest in this company. I mean, I'm not going to say never, but this is a company that IPO'd, as you can see, in March 2025. So I don't have what I like, guys, and that means a long-term track record. This is a risky investment, is a more speculative play, in my opinion. I stay away from it because I prefer to invest in well-established companies that have gone through different business cycles, that have lived through business cycles, okay? And eToro is just not one of them. And if I were ever to invest in a broker, that would probably be Interactive Brokers because their financials are solid and they, in my opinion, are the best broker out there. Okay. And so, but I mean, look, is this thing cheap? How can I say? I don't really know. I don't think I have any edge here, but let me see if you cannot get hurt. I can see that total revenues are going up, but look at that. It only goes back to 2025. So I don't understand the durability of this moat, and I don't even know if they have a moat in the first place, because that's one thing that you should be very clear about. If you don't know what the moat is, never invest in a company. What stops eToro from being displaced by other brokers? Okay, I don't know that. What kind of competitive advantages do they have? I don't know that either. I can see that earnings are going up, okay, but that's only 3 years. So I can see that cash from operations are also going up. Free cash flows are also going up. But this doesn't tell me much. In addition, as you guys know, I don't like to invest in companies that are new because what happens is more often than not they are diluting existing shareholders. Now look, granted, they are still new. They can, if they dilute shareholders by 20%, say, but then they grow earnings by 40, 50% over time, that will, of course, offset the dilution. But again, all of that creates uncertainty. And so I think you have far more interesting plays out there. If there are better and higher uses of capital, okay? And so I'm going to take a quick pass right here. That said, I think the financials, okay, maybe they look okay, but again, it's only 3 years. I can't make an educated guess about where the company might be in the next few years, okay? So for me, this one is a pass. And the other one that was also highlighted, that was also suggested, was Mint. Is that Mint? Mint? Yeah, Mint Technology. This is it. Okay, so let me have a look at something else here. What are the insiders doing? We don't have any information right here on stock unlock, do we? Show only company executives. Okay, so I can see that insider ownership sits at about 4%. The founder and executive director has $30 million worth of stock. And if we go here to the market cap, that's about the market cap is 2.5 billion. I mean, he owns a substantial amount for sure. And I can see that the free cash flow yield is quite high. So the company might be cheap, but again, being cheap is not the only thing, right? Look at the earnings yield as well, quite high. Yeah, so that's it. Let's discuss Mint Technology right now. What is this? So this is a company that the IPO was in 1994, so we have many years worth of financial data, which is good. The only thing that I don't like is the sector. I don't invest in energy companies, oil and gas companies, precious metal companies, commodity-oriented businesses. And the reason for that, as I explained quite a few times already, is because of inconsistency and unpredictability in the numbers, right? So in earnings and free cash flows. And that's probably the reason. Why is this only go back to 2025 here? I don't know. But let's check this here. If I show you the income statement, okay, let's go back to 2018. Okay, so look at this. Going back to 2018, you can see that the company hasn't compounded money. I mean, look at that, right? In 2018, they were producing $48 billion worth of revenue. Excuse me, $48 million worth of revenue. Right now, they are at 46. So revenue actually declined during this period. I mean, I would never invest in this company. Okay. And I'm being as blunt and transparent as I possibly can, because you guys know that I like you to make sound investment decisions. Not to say that you cannot make a lot of money here, but I'm telling you exactly that I wouldn't put my money into this company and why. All right. I don't like this. In addition, let's have a look at earnings. I mean, look at this shit. I mean, since 2018, earnings were negative all the way down here to 2024. You see, this is why I don't invest in commodity-based companies, because no matter how great the company is, how great management is, the performance of the company will always be linked to the performance of the underlying commodity. And that is something that you cannot control, right? I can be a great capital allocator. I can own a business, but if oil is going to go down over the next decade, I'm going to be hurt if my business is around oil, right? So my earnings are going to be hurt. So I don't like this at all. Again, no predictability, consistency. I knew the moment I saw that they were an energy company that this would be the case. And sure enough, here is what we have. And if I show you free cash flows, let's have a look and see what we have. Look at that. It was negative, and now it's positive, but it's declining sharply. Anyway, I don't like that. Okay. So I don't like to see that. In addition, I can see that stock-based compensation is going very high, skyrocketing, which is another cause for concern, in my opinion. Let's have a look at their margins. Yes, because they are unprofitable many of the time. I don't see anything. Yeah, I don't like this. Let me just have a look at the diluted shares outstanding. Yeah, look at that. In addition to all the red flags that I alluded to, you can see that they have significantly diluted existing shareholders. In fact, since 2018, you can see they have diluted shareholders by 550 and 65%. And so this is a big red flag, my friend. Stay away from this company. I don't like it. And again, they are they are higher and better users of capital. These management teams, they are probably pigs, diluting existing shareholders by so much without creating significant value, and that justifies the stock being down sharply from its all-time highs. Okay, so that's it. That wraps up today's video. Let me know in the comments below if you found this video insightful. If so, and if you are not yet an existing client or a school subscriber, then make sure you continue to spread the word, because that really helps the channel to grow. Thank you so much, everybody. Thank you. Be safe.